In Germany, income tax is withheld directly at the source for two types of income. In the case of wages, that is, income from employment, the employee does not receive the full agreed-upon amount. The employer withholds the income tax, referred to in this context as wage tax, and transfers it to the tax office. The employee receives only the net wage. The amount of wage tax corresponds to that of personal income tax and is therefore dependent on the amount of the wage. Wage tax is considered an advance payment of the employee's personal income tax. Withholding tax also applies to income from private capital investment. When a stock corporation or limited liability company, GmbH, distributes profits to its shareholders, or when a bank makes interest payments, income tax is deducted directly. The tax is transferred to the tax office by the company or the bank, and only the net capital gains are paid out. The tax withheld in this case is called capital gains tax. Unlike wage tax, a flat rate of 25% capital gains tax is always withheld and remitted. Since capital income is taxed at a flat rate of 25%, the capital gains tax has a finality effect. Taxation is completed through withholding tax, and the capital gains no longer need to be reported on the income tax return. Both taxes are forms of personal income tax. Wage tax constitutes an advance payment of income tax by employees. Capital gains tax covers the income tax on investment income. This naturally raises the question why withholding tax exists. For one thing, it serves to secure tax revenue for the national budget. For example, this prevents employees from spending their entire salary and later being unable to pay their income tax. It also prevents situations where taxpayers, for instance, leave the country and can no longer be located to pay their taxes. The second reason is the liquidity advantage for the state. With withholding tax, the state receives tax revenue immediately and does not have to wait for taxpayers' tax returns or collect advance payments. The final and perhaps most important reason, however, is the simplification of procedures. Employees generally do not have to file an income tax return. Since the vast majority of taxpayers in Germany are employees, a large number of citizens are spared the administrative burden of preparing an income tax return. This also eliminates the administrative burden on the part of the tax authorities to review tax returns and issue tax assessments. Capital gains subject to withholding tax no longer need to be reported on the tax return, which also significantly simplifies the process.